Now it's time for me to hand over to my colleagues in London for the next part of the Global Boardroom. Andrew Hill, our management editor, will anchor the next few sessions. I do hope you've enjoyed the Asia section of today's Global Boardroom as much as Jamil and I have. Before Andrew takes over, it's my great pleasure to introduce our next keynote speaker for a session that's also being streamed live on ft.com. The Governor of the Bank of England, Andrew Bailey, joins us now for a conversation with our economics editor, Chris Giles. The Governor took part in the first edition of the Global Boardroom back in May, so it'll be interesting, and maybe market-moving, to hear if his perspectives have changed at all as the UK struggles through yet another lockdown. Immediately following this fireside chat, we'll have our first extra time session. Chris and the FT's deputy editor, Patrick Jenkins, will give us some spot analysis on the Governor's comments, plus answer your questions. So do remember to send them through using the box on the right of your screen. Stay with us.
Hello and welcome to the FT's Global Boardroom. I'm Chris Giles, the FT's economics editor, and it's my great pleasure to be joined this morning by Andrew Bailey, the Governor of the Bank of England. I'd like to also welcome some new audience members joining us from ft.com. And if you want to tweet about this session, the hashtag is #FT Global Boardroom. If you want to ask a question, on the right-hand side of your screen, you should see a Slido widget, and you can just enter a question there. Governor, if we may start with what's happened just in the past hour. We've had the latest GDP figures for Q3 for the UK, and we saw some good news in that the growth of the economy was extraordinary in the third quarter at 15.5%, but we're still 9.7%, nearly 10% below where we were at the end of the last year. Can you just put this in the context of how you see the economy at the moment?
Yeah, well, morning, Chris. Yes, so I mean, that figure is pretty much in line with where we thought it would be. We tended to prefer to also, in a sense, use as a benchmark where the level of activity is relative to where it was at the end of last year, i.e. a sort of pre-COVID read. So that puts it between 9 and 10% below where it was at the end of last year. So to put that into perspective, the comparable figure at the end of the second quarter was something like 22%. So as you say, that's a strong recovery. But here's the challenge. As you say, these numbers are remarkable in historical context. So to say, well, it's improved and it's now 9 point something % below where it was at the end of last year, probably around about 9.5 actually. That's a huge gap. It's better than it was at the end, a lot better than it was at the end of the second quarter. So we have seen a recovery. But the 2 points that I would draw out is, one, I'd say there is still a very big gap. Secondly, the recovery has been very uneven. I mean, no great surprise there, really, because obviously that unevenness reflects the pattern of activity across the economy and obviously the pattern of restrictions across the economy. But I would emphasize that it is an uneven recovery.
Yes, and there's another piece of news that's happened, I think, since your forecast last Thursday, which, of course, is the announcement from Pfizer and BioNTech that they've been successful in phase 3 trials for a vaccine for coronavirus. Can you just fill us in on how this would affect your outlook for the economy in the months ahead?
Yes. So first of all, I mean, it's obviously encouraging news. I mean, it's encouraging for all individuals, it's encouraging for businesses, and it's encouraging for the economy. Probably worth starting by just putting a bit of perspective on what we assumed as the sort of backdrop to the forecast. We obviously don't make any sort of precise forecast about when any particular medical intervention, medical improvement is going to take place. But what we did have in the forecast was a sort of conditioning assumption that after the end of the first quarter next year, i.e. after the end of the winter really, there would be a sort of gradual and progressive improvement in conditions, which would reflect a gradual advance of, if you like, of treatment and vaccines. We made no assumption about some waterfall or moment when a vaccine came on stream. So, I mean, I think the news is encouraging. I'm not saying, I think like many of the other and many of the much more expert responses than I would give, I think we have to be cautious because obviously there's still quite a way to go in terms of the trialling. And there's obviously then the question of production and distribution and actually getting it obviously into action. So I think it's, first of all, it is broadly consistent with the way in which we condition the forecast. But it is very encouraging because it's the first, in a sense, it's the first very sort of encouraging piece of news that we can put greater confidence in that. And that has the other really beneficial effect that it reduces the huge level of uncertainty that we have, obviously, in the forecast at the moment. So that starts to see a way to reduce that uncertainty.
And what about the longer term? Because you've got an assumption in your forecast that in the longer term, there's quite a bit of scarring. So long term, the economy, almost 2%, which is £1 billion, so quite big money. Does the vaccine mean that the amount of change that we might think the economy has to go through isn't as large as maybe you feared?
Well, that's a really interesting question. So let me say two things on that. Let me just start by saying our level of scarring is quite a bit lower than many other forecasts. And why is that? Well, I think one reason I would give, and I don't give this to criticize other forecasts, it's hugely uncertain. But we did spend quite a lot of time in this forecast round looking at sort of, what is a way to, in a sense, think through the economics of the scarring assumptions. Now, I think one thing for me anyway, that we came to and concluded is that looking at history is obviously useful and important, but it's easy to actually take history rather literally and actually come up with rather large figures for scarring in this situation. Let me explain why. Some of the largest figures in history for scarring come from the 1980s and 1990s. And if you extrapolate those figures, I think you get bigger figures than we had. On the other hand, what we saw in the 1980s and 90s was a very obviously pronounced and sharp shift between sectors. So essentially we saw the decline of heavy manufacturing, heavy industry, coal mining, and the shift into a service economy. And that created larger capital scrapping. It created larger structural unemployment, which went on for longer. In this situation, our view is that what we will see in terms of scarring, if it does come to pass, and I'll come on to the vaccine in a moment, is probably more within sector, more within services. So we did take the view that if you take the logic of that sort of train, then it probably suggests that more capital is probably redeployable, and while there would be retraining needs and obviously sort of so-called mismatch unemployment, it might be rather lesser in scale and impact. Now, I think the vaccine is positive. The earlier a vaccine comes in a sense, comes into effect, the more positive that is. Though I would caution that we were at the positive end to start with, so just caution in terms of our forecast. But I think there's two reasons for why it would be positive. One, obviously, the sooner that way out of COVID comes into effect, the more businesses are likely to survive in financial terms. So those businesses that would find that they just couldn't survive Obviously, the shorter the duration of the COVID period, the fewer there will be. I think the second one, and this is much harder to really form a view on, is to what extent will there be lasting changes in the way, in the sort of the structure of the economy, so the way people work, where we buy things, and so on. Now, my guess is that I think we will still see changes, and there will be effects, but it's not unreasonable to think that the shorter the duration of the COVID period, possibly the more muted those effects would be. But that's all pretty tentative, Chris, to be honest with you.
Yeah, one thing that isn't tentative is something you've actually done, and you did in your last meeting, was announce another £150 billion of quantitative easing to support the economy in 2021. Lots of people are wondering, what exactly does QE do? How does it work? What's your take on, how would you explain to people, what does this do to the economy?
Well, I'd say it's interesting. One of the hardest questions I always find answering in my position is when people say, well, so how do you actually print money? Actually, we know how we print money literally, but how do you do this sort of magic of money printing? So I think the way I tend to describe it is this. What we're actually doing is we're buying one set of assets which are less liquid, less immediately usable, and substituting for them essentially cash, which is more easily usable in consumption and investment in the economy. So in a sense, we are creating liquidity in the economy that way through the injection of central bank reserves in return for us, in a sense, taking what is mainly government debt out of the sort of the stock of assets in the economy and putting them on our balance sheet. So that's the way I look at it. And the other reason I say that is because I think there are two broad ways to look at the impact of QE for me. One is obviously the effect it has on the price of money, so on the yield curve. The second one is to say, well, what would be the counterfactual, in a sense, within the economy, going back to this point about the sort of the stock of assets, in a world where that stock of assets was less liquid, and there was frankly a degree of crowding out potential in terms of the necessary stock of government debt that's been created. So that's the way I tend to look at it. Yes, it does involve us purchasing government debt. Yes, it does reduce the government's cost of borrowing, but that's not the direct target, as it were. The target is actually the overall economy, and the easiest way to, in a sense, affect that shift in the liquidity of the economy is to target government debt at the moment.
How do you go about calibrating what's the right amount? Why 150, not 100 or 200? You must have a sort of a rule of thumb somewhere in your back pocket about what does £50 billion or so of QE do? Yeah,
well, that's a very good question. So there's two things that we really focus on, neither of which is easy, but one is, it's sense I describe it as more traditional in the sense of anything is in this world, which is, what is the impact of that degree of purchase on the inflation target, on inflation, and therefore on where inflation is relative to target? So that is not unlike, obviously, it's very similar to how we would look at an interest rate change in that sense. We look at the fan chart of inflation and where that stock of QE takes us in terms of the target at the horizon. And as you can see from what we published last week, it broadly takes, on central case, it takes inflation back to target towards the horizon. The second thing, which is actually, I think, now much more prominent than it probably was in the sort of, if we can ever remember back to when we were in normal times, is more the sort of what I call the monetary strategy question, which is if you like, the consequence of the announcement effect of QE, because I think there's a long debate that central banks have about what I call the stock versus flow. So I think many economists would tell you that it's the stock, it's the announcement stock that matters for the economy and for expectations. So then you have to say, well, if we did 100, did 150 to 200, what does that mean? And of course, that's also what does it mean relative to market expectations. There's obviously another view, which is, that's part of the story, but the other part of the story is what is the flow going to be? In other words, what are you going to buy, but by each month, as it were, and how does that get sustained? That's slightly more, I think, well, I'd say controversial. That's probably overstating it, but there's more debate around that. It's probably more state contingent. I think back in March, when we were in sort of conditions of sort of financial stress, the flow really mattered because it was how much liquidity you're putting into markets. I think probably now the flow, it is certainly looked at by markets, and all the intelligence and commentary we get back from markets is that they do, but I think it's probably relatively less significant.
So is the essential mechanism that you're using is if you think inflation is likely to undershoot, you'll do more QE, and that's what people should expect. And if we see inflation beginning to rise closer to the target, you'll do less, or even begin to think about rate rises. I know that you've got some guidance there to say you have to be absolutely sure inflation is going to overshoot before you vaguely consider rate rises.
That's right. I mean, crucially subject to the guidance, which we'll come on to. You're right that essentially there's no difference in the sense in how we look at QE from how we would look at a rate change. The guidance is important, and that comes back to, of course, the world we're in, because the two defining sort of characteristics there. One is the obviously very elevated level of uncertainty, and the second one is the skew or the risk in the forecast, which is heavily to the downside. So we obviously publish what we call a modal forecast, i.e. it's the point in the distribution of outcomes with the highest probability. But given the skew, the guidance in a sense points more towards the mean outcome, i.e. taking the skew into account. And the guidance in a sense is consistent with that. What the guidance is saying is, look, we're going to need, because of the uncertainty in the skew, we're going to need more evidence than might normally be the case to convince us to take action going in the other direction.
To create some certainty for markets and for investors in government bonds, quite a lot of central banks, notably the Japanese, but also the European Central Bank and the Fed, have been moving in the direction of what's known as yield curve control, where essentially you say we are not going to allow any part of the yield curve interest rates to rise above a certain level. Is that under consideration at the bank?
Well, I think the way we tend to think about yield curve control versus QE is yield curve control, I think, as others have used it, tends to operate towards the shorter end of the yield curve. So one way to look at it is that, obviously in classic monetary policy, the central bank is targeting the overnight rate and then allowing that to sort of, in a sense, ripple out through the rest of the curve. What yield curve control is doing is saying the central bank is going to do more than that. It's going to target overnight out to some point, 3 or 4 years, let's say. QE is operating across the curve as a whole and will probably have more of an effect on the long end, not least because of the mixture of assets that we would purchase. So we have talked about yield curve control because, frankly, in the current environment, as I say, we talk about all the tools that could possibly be in the box because that's the world we live in. I must say at the moment, and if you look at the situation in the UK, there isn't a great call, I think, at the moment for doing more yield curve control at the short end. We've had actually pretty stable yield curve, short end of the yield curve recently. Moved earlier this week, but that's unsurprising because that was on the very encouraging news on the vaccine. So I don't think it's something that I would see, frankly, a great need for at the moment, given the behaviour of the curve.
If I could just move on to the subject that lots of people have been very excited about over the summer of negative rates. You've said it's the summer that it's in the toolbox, but yet it's not operational yet. So it's sort of in the toolbox and not in the toolbox at the same time, sort of Schrödinger's negative rates, if you'd like to like that. When do you foresee it could be used, as it were, your review of the operational elements of it in the banking system? When is it possible for MPC members to be able to vote on it? Do you think it has gone down a little bit that it'll be used?
I don't have a sort of precise date in mind, and the reason is that the work we're doing, which you described, is right down in what I might call the sort of the plumbing of the system, and we're in sort of detailed discussions particularly with banks about that, because when I say the plumbing of the system, obviously, it would be I think I've described it as a cardinal sin on our part to say we've got this tool. Let's say we got to a moment when we decided it was the right time to use it, and then people turn around to us and say, "Well, I don't know what you think we're going to do now," because actually you do realise that our IT systems won't accept negative numbers, or if we try to put a negative number in, it sort of blows up. Another reason is because obviously many of these systems are not, they're varying ages, and it's more than probable that they were created in a world where people didn't sort of think there was any likelihood of negative rates. So that's the work we're doing at the moment. I mean, it's interesting because, of course, I'd sort of draw a distinction here between what I might call the more sort of bank end of systems. I mean, banking transactions and market transactions. Obviously, we've actually had a negative curve throughout quite a bit of this year in markets in the risk-free curve out to about 7 years actually. So that sort of world is used to it, and obviously other central banks are using them as well. But there's a great deal of work we have to do with banks, particularly to work out what's doable and what needs to be fixed before we can use them. And I'm not going to put a date on that, frankly, at the moment, because we don't have the sort of all the information back yet.
I think I'm now going to go to some audience questions, if I may. We have a question which is about a no-deal Brexit, which is that if we do get to the position of the end of the year with a no-deal Brexit, what's the implication for monetary policy? Would it require a further easing, would you think?
Well, if I go back to the forecast for a moment, we conditioned the forecast, as we always do, on what we call stated government policy. And stated government policy, I take to be to have a trade deal, and obviously the talks are still going on. So in the sense of actions speak louder than words there. What, however, we also introduced was that, of course, any trade deal at this point will involve a degree of adjustment because we're leaving the customs union and we're leaving the single market. And so we did introduce that into the forecast broadly over the first 2 quarters of next year. And there was a degree of disruption, therefore, to economic activity over the first 2 quarters of next year. Now, just to put that back into the perspective of your question, obviously the no trade deal situation is in a sense, is a default to WTO terms. And I think there would be 2 consequences of that, to my mind. One, obviously, is the literal consequence of the difference in terms of trade, particularly in tariffs. The second one is, and this is much more imponderable, is it might be reasonable to expect that in a world where there is a trade deal, there will be a greater degree of cooperation and goodwill to, in a sense, tackle the adjustment issues. UK government, as you know, has actually said it's going to phase them in over the course of the next 6 months, 6 months after the beginning of the year. In a world where there is no deal or the default to WTO terms, I mean, I would sort of guess that actually that's less likely. So in other words, there would be a greater disruption effect. Now, again, so the effect of that in terms of monetary policy, we would then have to go back and obviously look again. And obviously, that, just to state the obvious, that has to then be taken into the mix with whatever the evolution of COVID is.
And is that something that you would expect to be doing at your December meeting? So that could be a more live meeting than it's often been in the past, because by then I'm sure we will know where the Brexit negotiations are going.
Well, I'm sure we will have more information. So in one sense, yes, I mean, the only problem with what you just said, Chris, is that there were people who were saying that, of course, we were expected to know by now, and we don't. So, but on the basis that time is evolving, I sort of think you must be right in that respect, but there's still a level of uncertainty, obviously.
We have another question is about central bank digital currencies, and the question is it possible in the next 10 years, and what does that mean for cash operations in the UK and the use of physical cash?
Well, I think it's possible, yes. But there's a lot of work to be done to get to the point where it would happen in all sorts of ways. I mean, so the interesting thing with cash, I always call it the paradox of cash, is this. There's no question that the use of cash in payments in the economy is declining. Now, it was it was declining before COVID came along on a sort of steady trajectory, but probably increasing in terms of rate. I think during the course of this year, obviously, I think it's gone into a very different phase in terms of the decline in usage. The paradox is that meanwhile, the stock of cash and the stock of Bank of England notes in circulation has continued to grow. That's and there are various reasons that we can put forward to explain that paradox, but it is something of a paradox in terms of predicting the future of cash. I think the case for digital currency, central bank digital currency, I'd start slightly at the other end of the sort of spectrum and say, if there is a case for having digital currency, let's leave central banks to one side for a moment and get to them later, then what form should it take? And the interesting, I mean, the question of the case for digital currency isn't to my mind a sort of slam dunk, because you've got to ask the question, what is the demand for digital currency versus the many other means of payment that exist today? But let's assume that there is such a demand. Then the question is, on what terms and with what assurance and protection for the public should it be provided? And particularly what level, when the public use a digital currency for payments, what assurance should they have about the value of that currency? And I think they should have a very high level of assurance, because I think people don't want to worry about the value of the thing that they're using to make payments. They want to worry about its operational robustness, but worrying about whether it will change in value while they're making a payment, it seems to me to be something the public shouldn't have to be concerned with. Now, I think that drives a lot in terms of what form should digital currency take, and what assets should back it, and what claim on those assets should the people who hold it have. And then you get to the question, well, if you sort of frame it in that way, I think that really means people should expect that it's backed by risk-free assets and should have a direct claim on those risk-free assets. Is that a viable commercial proposition, or is it essentially at that point a default to a central bank currency, if you like, a sort of an official currency? And I don't think we've answered that question yet, because there's a lot of imponderables in that question. But I think we will need to do so, and I think that will in good part answer the question.
Thank you very much. And I think, unfortunately, we could have gone on for a very long time, but we're
a big subject.
Thank you very much, Andrew, Governor Bank of England, for being with us this morning. If you're watching on ft.com, you can go to the FT Global Boardroom to register to see other sessions. That just leaves it to me to say thank you very much, Andrew.
Thanks, Chris. Thanks.